So, Citadel is, of course, one of the largest hedge funds in the entire world. In fact, Investopedia currently ranks them as the #1 largest, being led by founder and current CEO Ken Griffin, who first started trading stocks from his dorm room in Harvard as a 19-year-old sophomore before creating Citadel just 3 years later, having now grown it to an entity that really holds hundreds of billions of dollars in assets. So it's absolutely wild just how big and large they've become over time. Anyway, fast forward to today, and Citadel is constantly being talked about in the investing world, sometimes even for controversial reasons, as the founder is actually the owner of both Citadel Advisors, the hedge fund, as well as Citadel Securities, which is one of the largest market makers in the world, providing liquidity to the market while also holding tons of buy and sell information that could theoretically be used as insider information for the hedge fund. Now, I'm not saying that they do any of that, and I have no knowledge of them ever doing anything illegal, but it's something that has been talked about in the investing community, kind of speculated over as having the potential to be a conflict of interest if it were to ever be used inappropriately. Again, I'm not saying that they do that. I have no information about any of this, but what I do know is that last quarter, Citadel, being again the largest hedge fund out there, made some giant stock purchases. These were increases here of hundreds and even thousands of percents to their positions. And the only reason that I know any of that is because they have to release it to the public every quarter. So in today's video, we'll be running through the 5 largest of those purchases. I'll share, of course, my opinion on each one of them, and I'll even rank them from best to worst too based on that opinion. So hit that like button if you're enjoying my videos. It really helps keep my channel alive. So thank you so much for that support. But let's go ahead and jump straight into this list. All right, now we'll be sorting these from smallest to largest position in the portfolio among these stocks here that we're talking about, with purchase number 1 actually being a pharmaceutical giant that I happen to own myself too, in Bristol Myers Squibb, ticker symbol BMY, which Citadel increased their position on by a massive over 3,000% last quarter, bringing the stake up to almost $500 million, which is still not even worth just 0.5% of the overall portfolio. That's how big they are. Anyway, now the interesting thing really about Bristol is that the business is very large and dominant, yet the stock price has fallen hard in recent years, being down about 40% from the top and leaving it also negative over the past entire decade. So from that perspective alone, it's actually a very interesting stock that I think is worth looking into, especially considering the sky high dividend of close to a 5% yield. It's one of the highest that it's been over the past decade, as well as the dirt cheap valuation of a forward PE of only 7. The sector median, by the way, is about 3 times larger than that. Still, there are several concerns. Most notably has been the lack of growth, with sales even falling a bit in recent years too. This being caused by patent expirations and not enough new drugs and treatments to make up for it. These are some of the biggest patent cliffs that Bristol Myers has faced in a very long time. However, the hope is that some new moves that they've been making recently should help the company turn things around over time. Now, this includes some large acquisitions of multiple different companies to help build out their already large pipeline of future products, including the acquisition of Karuna Pharmaceuticals for a whopping $14 billion, as well as Mirati Therapeutics and Raise Bio, each worth about $5 billion respectively, with all 3 new companies also having several experimental therapies in late-stage clinical trials that could become blockbuster drugs, generating over $1 billion in annual revenue each in the future. And already we're seeing Bristol's growth portfolio of 12 younger drugs see a rise in momentum, having increased their sales by over 20% last quarter year over year, which is very impressive. It's a very good sign. Now, time will tell how much these moves will ultimately lift the company up long term, but I just think that for such a cheap valuation for a company that has also paid a dividend for over 9 decades in a row, and is really a company here that I just can't envision ever disappearing or going away because of how big they are and how important they are to the pharmaceutical industry. Well, I just feel like it's worth taking a chance on with the stock. So I agree with Citadel buying the stock here at these prices, and I'm going to rank it pretty high at number 2 because of it. Moving on to purchase number 2, though, we have a pretty controversial company here and stock these days, which is kind of crazy because they used to be really a beloved company by everyone until just these past few years. And that is, of course, Disney, ticker symbol DIS, which Citadel increased their position on by over 300%, bringing the stake up to over $500 million. Now, like I said, this used to be a very beloved company. In fact, even to this day, it still ranks number 12 in the entire world from Fortune's most admired companies. It's out of any company in the entire world, so it's a big honor there. And that might be a little hard to believe, though, these days, considering just really the poor performance that they've had in recent movies and shows that they've released that have largely flopped and really costed them many billions of dollars along the way, which, speaking of, even as high as Fortune does rank them, well, this was still a year-over-year drop of 6 places, one of the largest drops in their history. So clearly there is some consumer backlash going on for Disney's products these days, much of which has caused the stock to crumble in price, not only losing more than half its entire value from the top, but it's also negative over the past decade. Guys, that's something that would have really been completely unheard of in the past when talking about Disney. Nobody would have ever expected Disney stock to perform so poorly long term. Now, having said that, some of the stock crash was also due to the heavy costs associated with turning to video streaming, notably through Disney Plus, but also along with Hulu and ESPN Plus, as investors really feared that it would only become really a bigger drag on their already struggling profits that had taken heavy damage during the pandemic when their parks and resorts and other things had either closed down or operated at limited capacity. However, I think both fronts could actually be seeing a turnaround in the future, and so it may be the case that Citadel and other large investors too are buying in now for that turnaround potential. And I know I have myself recently too. I feel that if Disney can execute, there is some turnaround potential there. And we're already seeing some moves that could potentially be hinting towards that. In fact, recently, Disney has started to cancel some poorly written projects that consumers were not embracing, while also bringing back fan favorite characters and actors of the past. Now, on the profitability front, the streaming business too also actually turned a profit for the first time ever last quarter, and that was a very positive sign. Yet despite these improvements here, the stock continues to be punished. Maybe that'll continue until we see more noticeable progress in the right direction. But for now, I do just feel that the stock is cheap enough to where it's worth buying. So I'm giving it the number 2 ranking overall. I'm going to push Bristol up 1 spot to fit it in just because I like Bristol maybe a tiny bit more for that attractive dividend. All right, moving on to purchase number 3, though, we actually have a very interesting one here that might be a little hard to explain, but that is QXO, ticker symbol QXO, which it looks like Citadel probably had a small amount of in the prior quarter before deciding to increase that position by over 575,000%, bringing the stake up to over $667 million. Now, the reason I say that this one is very interesting here, and a bit hard to explain about it, is because it's mostly a venture company that is aiming to acquire other companies for future long-term growth. Now, several things are actually pretty attractive about this one in particular already, notably that it's going after the building products distribution industry, one that is estimated to be worth $800 billion, and it's attempting to disrupt that industry through various acquisitions and strategic moves, offering all kinds of services within the industry, especially improving efficiencies through the use of technology and software and services and other things too, as well as, of course, mergers and consolidation, something that the industry has been kind of lacking. A lot of analysts have actually said that the building products industry will likely see a lot of consolidation and mergers in the future because it's so separated. What's the word I'm looking for? Separated? There's another word. Fragmented. It's so fragmented. Now, The ultimate goal of QXO is to eventually be generating tens of billions of dollars in annual revenue through the next decade and generating substantial shareholder returns in the process. Now, this wouldn't really mean much if it didn't have some notable backing and leadership to kind of back up those promises, but that actually is the case with QXO, as the founder and CEO has a really strong track record of similar success stories in the past, having not only completed more than 500 different acquisitions throughout history, but some notable examples also include his very first company, which was United Waste Systems, delivered 55% annual returns from when it was founded to when it was sold to the company that actually became Waste Management, one of the biggest in the world. He also co-founded United Rentals, which also delivered market-beating returns and became the leading equipment rental company, as well as XPO Logistics, which he acquired for $150 million, only to later turn it into the 7th best performing stock of the decade on the Fortune 500 list, gaining more than 3,000%, and later spinning off two other businesses from it that together generate over 20 billion in annual sales. So just from all of that alone, it does make this a very interesting stock. However, the problem for me is that while it does have around $5 billion ready to make a couple of big acquisitions, it still hasn't made any of those decisions quite yet. So there's not much to look to here in terms of financial performance or even the stock valuation at the moment, which, by the way, this stock also has zero analyst coverage on Yahoo Finance. So it's just too difficult of a stock for me to judge or give too big of an opinion on. However, I will give it the number 3 ranking regardless, because it is at least one that has a proven CEO at the helm steering the ship. And it's also seen a giant like Citadel buying up a ton of the stock, which tells me that it's probably going to be a winner in the future if big investors are loading up on it too. I'd have to do a lot more research myself though before I could even consider to buy this stock as a meaningful investment, but it is one that I'm probably going to start tracking myself just because I do find it interesting. All right, that will, however, leave us now, though, with the final 2 purchases of the list, which are also the largest of the portfolio relative to the other stocks that we've covered so far. And coming in at purchase number 4, well, it's actually going to be an ETF in the Invesco QQQ ETF, which Citadel increased by a whopping 584%, bringing the stake up to over $1.5 billion. Now, I'll keep this short as you guys know, I'm not the biggest fan of these very large, broad-based market ETFs, with Triple Q in particular being one that just simply tracks the NASDAQ 100, which is the 100 largest non-financial companies on the NASDAQ. Now, that's not to say that it's a bad ETF. In fact, I actually think it's a very good one. It's extremely large and liquid with a very low expense ratio, and it has very large exposure to tech, which is my favorite area of investment, with the top 10 holdings alone also making up about half the entire ETF, including some of my all-time favorite stocks like Microsoft, Amazon, Google, and more. But when it comes to ETFs, this is a criticism that I often get from some of my viewers, which is that I own too many different stocks, and some of them feel that I should just own a big ETF instead. But look, guys, in my opinion, that is such a weak argument, because I love to handpick my individual investments. And I actually talked about this in my most recent community portfolio update video, where a viewer literally mentioned QQQ, this particular ETF. He said that instead of my community portfolio, because it's having a lot of different stocks, said I should just buy Triple Q instead. But my argument is that I don't want to make the same decisions that an ETF would make. For example, looking at Triple Q, their largest holding, number 1, is Apple. I don't want Apple to be my number 1 biggest holding. I don't even want it in my top 10, if I'm being honest with you. And speaking of the top 10, Triple Q also holds Costco in their top 10. I don't even want to own Costco stock to begin with. So my point is that, look, ETFs are great for beginners or any passive-minded investors that don't want to have to do a ton of hard work or constant research, or maybe they want some exposure to a specific area. I think foreign ETFs or ETFs focused on a specific kind of theme makes a lot of sense in many different cases. But a broad-based like market ETF, no, that's not something that I've ever been interested in myself. I love to do the hard work. I love to handpick everything. It's one of my favorite things. I think it's super fun. I think stock market investing is incredibly fun. anytime that someone tells me that investing in stocks is boring or dumb, I feel like they're crazy. I don't know what they're talking about. I think it's one of the funnest things in the world. I love investing in stocks. And because of that, I'm just not the biggest fan of ETFs. In particular, very broad-based, like market ETFs like this one just doesn't make a whole lot of sense to me. But like I said, it's not a bad one. I'm still, I would still consider it decent for particular people in certain situations. But I'm going to put it in last place at number 4 because for me, it's not one that I think I'd ever be interested in. All right. Unfortunately, coming in at purchase number 5, it's going to be another ETF, and an even larger one at that, in the SPY S&P 500 ETF, which they increased their position on by over 50% last quarter, bringing the stake up to over $3 billion. And yeah, this one is very similar in terms of size, popularity, liquidity, and expense ratio, but the main difference is just that rather than tracking the NASDAQ 100, this one tracks the S&P 500, which is commonly referred to as the main benchmark for the US stock market, as it's made up of 500 of the largest companies by market cap. And again, I have the same feelings about this one. It's a little hard to rank it up against Triple Q because I feel that Triple Q is more heavily focused on tech, which I like more, but that also means it has a little less diversity that SPY would have. So there are some pros and cons if you're trying to put them up heads up against each other. It would be really hard to say which one I'd prefer, but I guess my bias or preference would go a little more towards Triple Q because I love tech in general, which, by the way, over the past decade, Triple Q has also risen by 374%, while SPY has performed about half as well. Now, that's still very reliable performance from both ETFs, but I just think I prefer Triple Q a little more because of that because of how it leans heavier into tech, which has performed better. I think it has more future potential, perhaps. So depending on how you look at it, anyway, I'm putting SPY behind them at number 5, and that'll give us our overall rankings here. Anyway, this will do it for this week's roundup of stocks that a giant investor is buying. Overall, I agree with the moves here by Citadel. I found them to be pretty interesting, and 2 of them I actually own myself too. So it's not a bad list by any means. I think they're all pretty decent, but this is how I would rank them. I would love to hear what you all think. Do you agree with my ranking? Would you make any changes to it? And do you like any of these purchases? Do you own any of these stocks? I'd love to hear your thoughts. But thanks again for stopping by, my friends. I hope you enjoyed the video. I hope you're all doing well. And I will catch you in the next video. All right, take care, everybody. Bye-bye.